What we're going to be going through here is just a basic example here on pension accounting, and we're going to look at the various accounts that are involved here for recording our pensions, and we're going to be using the worksheet format here for going through this example here. So what's involved with pension accounting here? Really, we got 6 different accounts that we have to be concerned with, and what we have first here, we're going to have 4 accounts here where those are the ones that affect our journal entries here for our balance sheet and our income statement, and then we're going to have 2 other accounts that we're going to look at where we're going to be how we maintain our liability here and our assets on these pensions. Okay, so let's first go through and look at our different accounts here. So what we're going to have here, our first account is going to be our pension expense account here on our income statement, and that's the annual expense here for the pensions. And then on our balance sheet, we're going to have a cash account here, and that's going to be for our pension contributions. And then we move over to also on our balance sheet here, but it's going to be part of the equity section here on our balance sheet, and that's other comprehensive income here, and that's going to be for our prior service cost. And we'll get into a detail here, a basic example on going through each of these accounts here. And then moving over to our last account here, that's going to be a pension asset or / liability account here. It's either our pension is either going to have an increase or decrease here, and that's going to involve either an increase as an asset here or a decrease here as a liability here. And this pension asset and liability account is really tied into the first 3 accounts that we looked at here: our pension expense, our cash, and our other comprehensive income. And then finally, we're going to move over to our 5th and 6th account here. This is where we're going to be maintaining our balances here. Okay, so first one here, this is going to be the projected benefit obligation. Again, these are just memo accounts. They are just going to be explaining what's going on in our other 4 accounts here when we record these journal entries. So a projected benefit, let's go and look at that. Projected benefit obligation here, referred to as PBO here, that would be the present value of vested and non-vested benefits accrued to date. So that's going to be a liability here. And then our last account here, we're going to be the plan assets. Again, it would be part of an asset account, and that really is whatever this plan here, this pension plan, whatever investments it have, like in stocks, bonds, and so forth. Okay, so let's start out here and let's go back to our first account here, our pension expense. That's our annual expense. Now, first off, let's go through the definition and we'll look at the 4 basic items that are included here in our pension expense. First off, first item here would be service cost. This is where we have an increase in the pension benefits payable, and it would be the present value of any new benefits earned. And that I'm going to show as a number. We'll go through the numbers here, but first let's go through the definition here, and that I'm showing here as our service cost. And then we have second item here would be, and these are the basic elements that are included here in your pension expense. Now the second item here is our interest cost. Now that's interest expense accrued each year on a discounted basis here on this pension, and really that's going to be our projected benefit obligation times some discounted interest rate. And then moving down here, we're going to have a return here, and what we're going to be looking at is the actual return on the plan assets. That would be like the interest and dividends that accumulate within the fund, and it would also be any increases or decreases in the market value of any stocks and bonds and so forth that we're holding here. So that would be a return here. It's in a return here, I'm showing it as a reduction here to our pension expense. In this case, we actually earn something on our pension, on our investment here. And then finally, we're going to have what they call the amortization of a prior service cost. And that's where we have an increase or decrease in benefits for the employee service provided in prior years. That would be like retroactive benefits to the pension expense, and it would be included in here in our future costs here. Okay, so that's going to be for our pension expense here, and let's just go through it. I'm throwing in some numbers here just as a demonstration purposes and to see where the debits and the credits go into what accounts. So looking first at that service cost, now that would be our pension benefits payable for any new benefits here. So in this case, I have 90,000 here shown here as an increase in our pension expense here. Again, a pension expense would be an annual expense that we're looking at here. So we have 90,000 here for the first for the year here. That would be our service cost, and we'll look at these three accounts here and then move over to see where they fit into our maintaining our balance. Now, our interest to cost, I'm just throwing that in here as $70,000 here. That would be the projected benefit obligation here times a 10% discount interest rate, and I have 700,000 here in a projected benefit obligation, and that's as of the beginning of the year here. And then thirdly here we have the return here on our plan assets, and I'm showing that as a reduction to our pension expense because we actually we earn something on our plan on the assets or investments we have, so that's going to reduce our pension expense. Okay, so looking at A, B, and C here, plan assets, C, reduction or a credit to our pension expense. The service costs and the interest costs were an increase here to our pension expense here. Okay, so let's go over here now and let's look at where these fit in here to our projected benefit, the projected benefit obligation here as our liability, and then we're also going to have our plan assets. So service cost here, we would credit it here or increase our liability by the 90,000 here for the service cost, and then the interest cost we would credit that here for 70,000 here. Okay, so we've taken our PBO here, projected benefit obligation, we increased it here based on the fact that we had some increases in our pension expense. And then thirdly here, the return. That was that return on investment. Now that goes against our plan assets here. So we would debit that here, and that's an asset account here. We would debit it or increase it here for $64,000. Now remember, pension expense was reduced by $64,000. The plan assets here would be increased by $64,000. Okay, so let's move back to our pension expense and finish it off here. So we have our amortization here of prior service cost. And let's just say that was the increase or decrease in employee benefits, in retroactive benefits. So let's just say we had an increase in it. We amortize it and we have some increase here of $10,000. So debit or increase our pension expense here for $10,000. And then the credit goes to, in this case, other comprehensive income, OCI here, for prior service costs. Again, equity here on our balance sheet. We're not going to go through all the theory here and that, but that we would credit that here for our amortization here of prior service costs. So credit here, increase our other comprehensive here income here on our equity section of our balance sheet, and then our pension expense would be debited here or increased. And then finally here, just looking at our pension expense, what you would do here, and we're going to be looking at the year end here, the year end here of X1 here, year X1. All you're going to do is net out your debits and credits here, and you're going to come up with $106,000 here for our examples here. We had 90,000, 70,000 here as a debit, and then we had that credit or reduction here by 64,000, and then another debit or increase here by 10,000. That equals $106,000. Okay, so we've taken care of our pension expense here by definition and how we handle our debits and credits. And in this case, you know, if there wasn't any return on our investment here, then we had a loss on our investment or lost some money, then we'd have to increase our pension expense here. But I'm just showing where we have a return, and then we also had some retroactive benefits that we were giving here, what we call the amortization here of prior service costs. Then you can understand where the service costs and the interest costs come in. Okay, so now let's go over and let's look at our second account here, our cash account, and that's really for pension contributions here. And all I'm showing here is we would credit or reduce our cash. In this case, the contribution here was for $105,000. So that's what we contributed to our pension account. Okay, so that's for our reduction here in our cash. And then for the year end here, that's all. The only activity we had was our cash account here. Credit or reduced here for $105,000. But let's look at item E here and move over to our maintaining our balance here. So what that goes here, remember that contribution of the that we made. That would go to our plan assets here. Again, memo entry here, and that was $105,000. So we'd increase our plan assets here by $105,000. Okay, so we've taken care of our contribution here. Reduced cash by $105,000, increased our plan assets here by $105,000. And then if we look at the case here where we had some payments to the retirees, we actually paid out of our pension account here. Now, you don't see anything coming out of cash. What you simply do, this becomes again, you take your projected benefit obligation here, you reduce it. We had in this case, $40,000. That would be listed as benefits here, so we reduce our projected benefit obligation by $40,000. And then moving over to our plan assets, we would credit that here, and that would be reducing our plan assets here by $40,000. So those are the payments to the retirees. You didn't see any cash transactions there. You handle that here between your projected benefit obligation and your plan assets. Okay, so now let's go back to our cash account here. So our year end, we had a credit, like we looked at, a $105,000 reduction here in our cash account, and that's really through our contributions. Then our third account here, let's look at that here. That was the OCI, or other comprehensive income, for those prior service costs. We would have credited that here for $10,000 that we looked at. And then that was the only activity for the year here. So for year X1, we're looking at $10,000 here. Now, let's finish it off here. Let's just say, for example, the beginning amount here, let's just say we had a negative amount here in our other comprehensive income of $150,000. Debit here, we ended up with year one, $10,000 here credit. So what we're going to really be looking at the end of year X1 is the balancing amount, $140,000, because our negative amount here was reduced by the credit or the increase here in our other comprehensive. So ending amount, $140,000. Okay, now let's go over, and this is really this pension asset liability account here. That's really a balancing account between our pension expense, our cash account, and our other comprehensive income. So the first thing we have to look at here is our beginning balance. It's going to be a credit here of $60,000. Well, how do we get that here? Now, that comes off our PBO here, projected benefit obligation, and our plan assets here. So really what we want to do is we're going to be comparing these two amounts here. Beginning balance, we had a $700,000 here in our PBO account here, and our plan assets, we had $640,000 worth. So how do you get to the $60,000 here? So you really go down here and you look at it in these terms. Our PBO here, if it's less than our plan assets, or that's projected benefit obligation here is less than our plan assets, then we would have a pension asset. In that case, we would have debited here our pension asset, because it would have become an asset, not a liability. So you can see what's going on here. Projected benefit obligation was $700,000. Plan assets was only $640,000. So we're going to end up with a reduction here. Our pension liability is going to be $60,000 here. Okay, so this is it's not really the balancing between debits and credits. You have to look at it in this relationship. So in this case here, the PBO here, a pension benefit obligation of $700,000, was greater than our plan assets here of $640,000. Then we would have a pension liability. So that becomes our pension liability here. Our assets are actually reduced. That is, we're looking at it in terms of assets here. We would have reduced our assets here by $60,000. And that's essentially increasing our liability here by $60,000. So you see here, $700,000 in liability here, beginning of the year here, assets of $640,000. So just remember how to handle your credits and your debits and credits here. Pension liability, $60,000 increase in the liability, $60,000 decrease in our assets. So that's how you have to start out with determine what your beginning balances here and your projected benefit obligation, your plan assets. Then you have to determine what your pension asset liability account is here. I'm showing it as debits and credits here for an asset. Just remember the relationship here. PBO less than our plan assets, then you have a pension asset. You would increase your pension asset. PBO greater than plan assets, then you would be reducing your pension assets or increasing your pension liability. Okay, so those are the rules that you have to follow. So then, continuing on with our pension asset liability account here. So remember, we had a credit here of $60,000. Now we come down to, we have to determine what we have here for the year ending year X1. And we're going to determine that to be $9,000. Now we don't want to go, only thing we want to do here is we want to look at it as a plug or a balancing amount between our other accounts. So let's look at it. Let's look at it in just these terms here. A pension expense. Let's go back and look at that. We had a debit here of $106,000 in our pension expense. So looking at it here, debit of $106,000. Then we're going to have we're going to have our funding here. We're going to have our reduction here in our cash for our funding of $105,000. So let's look at that. That's a credit here to cash, $105,000. Okay, so that takes care of that account. Now we have our amortization here to our what was that here? The PSB here, prior service cost, pre-SC, excuse me, prior service cost of $10,000. So where do we have that? That's a credit here of $10,000. Okay, so this is just not going through all the theory here, but just looking at our plug here between our debits and credits. So we have funding here, reduction in cash, $105,000. Our amortization here, other comprehensive income, a credit of $10,000. So what do we need here? We got the credits here. What would that be? $115,000. In our pension expense, well, we're sitting at $106,000, and we have to come up with a balancing amount here, and that would be $9,000. So that's simply how you got into your determine what your pension asset liability. In this case, it's an asset account. You increased it here by $9,000 simply because of the balancing entries here between your debits and your credits. First, after you determine what your pension expense, we had a debit of $106,000 here. Then our funding or our cash account, we had a credit of $105,000, and then our amortization here to prior service cost credit of $10,000. So that gives us what our balancing amount here. We need between our debits and credits here, $9,000. And what we could do while we're looking at this here, we can just go down, and this is really how we'd be recording this on our balance sheet. So on our income statement here. So what we would do is, this is the recording. Pension expense, debit that for $106,000. Then our pension asset liability, we would debit that here for $9,000, and that's based on an asset here. And then credits go to our other comprehensive income here, $10,000. And then our cash account was credited for $105,000. So that's how we would be recording this here on our balance sheet and our income statement. Okay, so you can see what's going on here. Just look at the relationships here. How do you determine your pension asset? And that's really become a plug here between our balances that we had in our credits and our debits here. So whatever's sitting in your pension expense and your funding here, and whatever is, if you had a debit or credit in your pension expense here, or your funding and your amortization here, prior service cost, then that's where you determine your pension asset, any asset or decrease in asset or liability. Okay, so that'll take care of our pension asset liability, except for the end of the year here. So let's just look at the end of the year. End of the year would become next year's balance, remember. So remember, we started out here with a credit or a reduction here in our asset account of $60,000, and that was really a result here from the PBO here, pension benefit, credit here being our liability here being greater than our plan asset, our plan assets, or debit here to our plan assets. That reduced our asset account here by $60,000. But we had an increase here in our plan assets as a credit here of $9,000 here for year one. So we're ending in year X1 here. The $60,000 credit here, debit of $9,000. Now we only have a credit here, or a reduction actually, to our pension asset of $51,000. So this, you see how important this pension asset liability account is. It works in conjunction with our let's move it over here. Our pension expense. Whatever's sitting in our pension expense, we look at the end of the year here. In this case, we had $160,000. Our cash account here, year end, we had a reduction here, a credit of $105,000. And then our other comprehensive income here, which is part of equity here on our balance sheet here. And that we were sitting at $10,000. So you see how we got to our pension asset. In this case, it was an increase here in our asset by $9,000. Now, we got to the end here, the $51,000 here in our, actually it would be a reduction here in our pension asset by $51,000 for the end of year X1. So now this is where we take care of our projected benefit obligation on our plan assets. We got to determine what the ending balance is for next year's amount. So what you would do here, you would see here that you just net all your amounts. Whatever you had, your credits here, we had a $700,000 credit, service cost $90,000, interest cost here $70,000, then reduced here by the benefits that we paid to the payments to the retirees here, $40,000. So we come up with $820,000 here. And then for moving over to our plan assets, well, we had a debit here, $640,000, another debit of $64,000 or increase here for our returns, and $640,000 was for a beginning balance, and then our contributions made here in cash contribution, $105,000, and then we had a reduction here in our plan assets because of the payments made to retirees of $40,000. So our net amount here is $769,000 here at the end of year X1. So what we're doing here, if you look at our projected benefit obligation here, our end amount here of $820,000, and our plan assets, we had a debit here of $769,000. You can compare them again. All you do is compare these amounts here. In this case, you'll see that our plan assets, or our projected benefit obligation here, is greater than our plan assets. $820,000 here in projected benefit obligation is greater than the $769,000 here in our plan assets. So this is the rule we use. If that's greater, PBO here is greater than the plan assets, then the pension is a liability here. So that would give us, those balancing amount is going to give us a liability here of $51,000. So you can see here, you can back through this here by doing your assessment here, making your comparison between your PBO or your projected benefit obligation and your plan assets to determine whether you got a pension asset or a liability. In this case, we had that liability or credit here, reduction in our pension asset by $51,000 based on whatever our sum amounts here was in our projected benefit obligation for the year here, and also our plan assets. But backing through it, if you go through these accounts here, remember the $9,000 here was based on our pension expense, our cash account, or cash pension contributions, and our other comprehensive income here for prior service costs. So we started out here with an amount. We ended up here based on our pension asset liability, based on those three accounts here that we talked about, and then we're able to determine our ending amount. So we really determined our end amount here, and it's really a cross-check here. So to cross-check your problem, you take whatever your beginning balance is here and any increases or decreases to your beginning balance. In this case, we had a decrease here or an increase in our assets, so we ended up with $51,000. And then cross-checking it with our projected benefit obligation here in our plan assets based on their ending amounts here through those changes that we had here for our pension expense, contributions, and our returns here, and our service costs and our interest. Whatever these things, whatever your amounts you come up with here, make your comparison, and that should cross-check here with your pension best asset and liability account based on what you had, the change you had here from the beginning of the year here to the end of the year based on those accounts. So that's really a cross-check here. Okay, so that'll take care of our example here, and this is really just a basic example, and these are the different accounts that you would be using here, and I have it laid out here in the worksheet format that we went through. And then just one last thing here, maybe we should go through that again here. Just remember what I'm showing down here, this pension expense, this is what actually goes to the balance sheet. Well, this expense goes to the income statement, but this is what you would record here. These amounts that we showed here for the projected benefit obligation and the planned assets, those were how you keep track of your liabilities and your assets here on your pension account. But what you would do for your recording here, that's based on those first 4 accounts here. So we had a debit here of pension expense, increased that by $106,000. Then that pension asset was increased here by $9,000. And then the other comprehensive income, well, we had a credit on that here of $10,000. And then our cash account, we had a credit or reduction in our cash account of $105,000. So this is how you would record it here. And just remember your pension benefit obligation here and your plan assets. Those are a memo account here to your whatever journal entries here you had for these other expenses here and so forth. Okay, so that'll take care of our example here, working through the worksheet format here for pension accounting.